Picture this. Two people decide to invest the exact same amount of money. One of them goes for a fixed deposit, and the other buys a government bond. Now, both of them are expecting fixed returns and a predictable, regular income. They probably think they're making nearly identical, conservative investments, right? But underneath it all, their money is about to enter two entirely different financial universes.
See, one investor just signed a standard bank deposit contract. The other? They just bought a tradable debt security. On the surface, they look like twins. But if they're so similar, why do they follow completely different laws? Why do they carry completely different risks? And why do they behave so differently when global markets start shaking? Well, by the end of this explainer, you're going to understand the hidden difference that literally changes everything.
Before we dive into all that, let's get the legal stuff out of the way. This explainer on the channel Block Spawns Funds is created for educational and informational purposes only and does not constitute financial or investment advice. All right, let's get into it.
So where does the money actually go once it leaves your hands? Let's trace the flow.
If we follow the money, you'll see two totally different paths. Think of the fixed deposit as this soft purple path. That cash flows straight into the banking system. It literally becomes a liability on the bank's balance sheet, which they then use to fund everyday loans for households and local businesses. But the bond money? That's the electric blue path. It completely bypasses traditional banking. It shoots straight into global capital markets to directly finance things like massive corporate factories, technology, and huge public infrastructure projects.
To really get why these paths split so drastically, we have to look at what these things actually are. A fixed deposit is, at its core, just a simple contract. As an investor, you're basically an unsecured creditor, lending your money directly to the bank. The bank takes your cash, guarantees you a fixed rate, turns around and lends it to someone else at a higher rate, and then pockets the difference, the spread. An FD is not a security. The bank takes on all the lending risk, and you just hold on to a deposit agreement.
Now, contrast that with a bond. A bond is a tradable debt security. It represents a direct loan from you, the investor, straight to the ultimate borrower, whether that's a massive corporation or a sovereign government. And here's the kicker. Because it's highly liquid, that bond can change hands between investors in the open secondary market thousands of times before the loan actually matures.
And because they are fundamentally different things, they're governed by completely different rules of the game. Let's shatter the illusion here.
The really crucial point to remember is that these two operate under completely separate legal frameworks. FDs are wrapped up in banking regulations. You're usually relying on deposit insurance, like the DICGC if you're in India, for example. Bonds, on the other hand, live out in the wild under expansive securities laws. There is no deposit insurance out there. Your safety net relies entirely on how financially healthy the issuer is.
So let's break down those bond risks, because they are real. Since you're lending directly to a company or government, you're taking on credit risk. This is why rating agencies like Standard & Poor's or CRISIL grade these issuers from a pristine AAA all the way down to a big red D. You've got to ask yourself, what's the default probability? Like, what's the actual chance they won't pay me back? And what's the loss severity if they do go under? Plus, you have spread risk. If a company's credit rating drops, the value of your bond drops with it. All of a sudden, similar expected returns definitely do not mean similar safety.
Now, you might be wondering, what happens if life happens and you need your money back early? Well, flexibility comes with a price.
If you want to bail on an FD early, you're pretty much trapped by that contract. You're going to get hit with premature withdrawal penalties and a slashed interest rate. Bonds are completely different. They offer amazing liquidity because they're continuously trading in secondary markets. But that incredible flexibility introduces a brand new hidden wildcard, market volatility. Enter the interest rate seesaw. This is literally a fundamental rule of finance. As central banks raise market interest rates, the prices of existing, older, fixed-rate bonds fall. And it works in reverse too. Lower market rates mean higher bond prices. Because a bond trades openly, its price has to constantly adjust so its fixed payout stays competitive with the shiny, brand-new bonds being issued today. So, what's the bottom line here? FDs stay contractually fixed while bonds are out there riding the waves of the market. Your FD principal never fluctuates, which completely insulates you from that daily economic seesaw. But a bond's market value? It's changing constantly. That's the exact risk bondholders are willingly accepting in exchange for liquidity and the chance for their capital to actually grow. Let's zoom out for a second. Let's look at the big picture and decode what this means for your actual returns.
Because bonds trade out in the open market, figuring out what you'll actually make is a lot more complex than just looking at a locked-in FD rate. The anatomy of a bond's return is kind of a puzzle. It combines your fixed coupon payments with the potential that the bond's price will go up or down. Mix that all together and you get what's called yield to maturity, or YTM. This means you could have two bonds with the exact same coupon rate, but they can give you vastly different investment outcomes depending on exactly when you jump on and off that interest rate seesaw.
And you know, managing this colossal global network of tradable debt takes serious architecture. It relies on something called the flow of trust. It's a heavy legal contract, a bond indenture, that's watched over by a trustee or fiscal agent. Their whole job is to provide legal and financial backup to protect you, the bondholder. It takes this massive, sophisticated ecosystem to make debt safely tradable.
Just step back and look at the sheer scale of it all. Step 1, your savings enter the system. Step 2, they split down these two incredibly distinct paths, bank deposits over here and capital markets over there. And then step 3, they merge back together to fuel immense global economic growth. One side relies on bank balance sheets and loan spreads, the other relies on market liquidity and direct financing. Together, they are the complementary engines that literally power modern civilization.
Which brings us to the real takeaway here. The biggest investing mistake isn't choosing between a fixed deposit and a bond. It's believing they were ever the same thing to begin with. They aren't just competing savings products where you pick whichever has a slightly higher number. They are two entirely distinct financial mechanisms. They transform your hard-earned capital into global growth through completely different institutional, legal, and risk pathways. Honestly, understanding this one distinction unlocks the true architecture of modern finance. So, I want to leave you with a question to chew on. When you make your next fixed income choice, which economic engine are you truly deciding to fuel? Think about it. Thanks for hanging out with me for this explainer, and keep learning.